Kevin Warsh. Warsh, sounds like Wash, but Warsh, right? Will he help or hurt the Fed and U.S. financial credibility? Gold prices have plunged from record highs last week, but they're bouncing back again. Is it time to buy or time to bail? And finally, AI just ate $300 billion in market cap value from software firms the other day. Will AI keep eating software, or is this overblown? We'll comment on all this and have 3 stock ideas for you on this edition of the Curia Investment Show. I am joined, as usual, by Owen Tracy of Fuller Tracy Money, reporting live in the flesh from Dallas, Texas. Owen, welcome.
It's always a pleasure.
All right, so before we get started with the serious stuff, Owen, let me share this. I'm going to ask, have you heard of, actually, give me 1 second to bring this up. I need a moment. Have you heard of the Frowning Cow is what I'm getting to.
No.
Does that ring a bell?
I've not heard of the Frowning Cow.
Okay, so the Frowning Cow, actually, let me bring analyst Xiaoping Huang, who's hiding in the background, in on this too. So Xiaoping, I'm going to show. Does this look familiar?
Not really.
No. Oh, so I'm the most Chinese of the group. All right. So this is a few weeks ago. This factor
those look like horses, by the way.
Oh, the frowning horse. Yeah, because it's the year of the horse. Duh.
Okay. So yes, the horses. Yes.
That's a tell right there. Yeah. So, yeah, a few weeks ago, this factory in Yiwu, where much of the stuff is made, accidentally misprinted misconstructed these things and had it's supposed to be a smile, but it just kind of stuck. And Labubus are on the way out. The market prices of Labubus have cratered, whereas these things are the new hot thing. So anyway, that's it. No substance, just random fact. So you've not. This still doesn't ring a bell to either of you guys. It sounds like.
No, it looks like you're very early in the trend.
I guess so. I guess so. All right. So getting back to substantive stuff, and Xiaoping, we'll bring you on a little bit later for the stocks. Let's talk about Kevin Warsh. Owen, I read, as pretty much always, your notes to your subscribers. This guy is contentious. The Wall Street Journal liked him. They wrote a pretty nice, pretty effusive editorial in support of him. He's a hawk. He left the Fed. He was a Fed governor from 2006 to 2011, and he just got sick and tired of all the easy money policies that were in place to support the recovery from the great financial crisis. So he just left. He thought it was kind of blurring the Fed's mandate with some political stuff, congressional pressure, fiscal and monetary policy blurring. Okay, all that sounds good to someone who is a fiscal hawk, who thinks the U.S. is spending too much money, who thinks that we should not lower rates too soon, too easily. But that seems at odds with Donald Trump these days, right? I mean, he wants lower rates. He's publicly, almost embarrassingly, I think, from the standpoint of the U.S., criticized Jerome Powell for not bringing rates down. What do you think happens here?
I think the large question about Kevin Warsh is his personal ethics. You know, that he was at the Fed and then he left the Fed, his former employer, and then proceeded to rubbish it. So that's never really a good look.
Yeah.
Now, there's also, of course, there's legitimate questions about, how the Fed is managed and what kind of job are they doing, and, their role in creating inflation with massive money and, printing and accommodation, and the wisdom of quantitative easing. These are all important questions, and you can question that without actually rubbishing the people that actually work there. But at the same time, now he has evolved his position. So now there's talk that you can cut interest rates if you also reduce the size of the balance sheet, because reducing the size of the balance sheet is going to be deflationary, whereas cutting interest rates in an economic expansion would be inflationary. And, then there's this whole talk about technological deflation. And I'm a big proponent of that. I think technology does create deflationary forces in the economy, but not from quarter to quarter. This is a long-term trend. It's just a sort of going on in the background kind of thing. I don't think you can base monetary policy on the back of technological deflation. So I think we're kind of in this interesting environment where, is he a political animal, or is he someone who has an actual basis for his beliefs and is willing to act on principle? So,
I don't know if you read Paul Krugman's essay, but that's literally what he called him, a political animal.
Well, I did not read Paul Krugman's essay, and there's not usually much I agree with when we talk about Paul Krugman.
I don't think you normally agree with Paul Krugman, but on this one you might. On this one you might, actually.
On this one I might. But one thing that I think is most important is we don't know, right? And this is an uncertainty, and markets abhor uncertainty. So this is what happens whenever you get a new Fed chair. There is this uncertainty. And I would say that on this occasion, there is probably more uncertainty than we are accustomed to. And the one thing that the market wants to know is, what will the Fed chair do during a crisis? Will he ride to the rescue? Will there be a Warsh put, like there was a Powell put and a Yellen put and a Bernanke put? So what happens generally? Markets kind of manufacture a mini crisis to figure out exactly what they're going to do. Or people just sit on the sidelines and they wait to see what happens. And I suspect that that is a little bit of what's going on in the market right now.
One of the things Paul Krugman mentioned was that the Fed, works with this board of governors, and even though the Fed chair is the most visible, the most vocal person, and in the past, 20, 30 years, they've been doing these press conferences and they talk to the public, it's still basically a Democratic vote. He doesn't have, or he or she, if there's ever a female, there has been a female, Janet Yellen, excuse me, the Fed governor doesn't have more voting power than the rest of the Fed. And the Fed governor needs to persuade the rest of the Fed to vote in the Fed governor's favor, or in favor of whatever ideas. And so the credibility of the Fed governor, not just with the market, but with the board of governors itself, is key. And he's not sure that Kevin Warsh has that credibility. In other words, he may have a great idea, a bad idea, but if they think he's a political animal, they don't trust him, things are going to be gridlocked and won't get anywhere. Do you agree?
Yeah, I think there's a couple of different things to unpack there. If we look at what has happened during President Trump's attempts to change various institutions, a lot of it has been cosmetic, and it is really focused on culture wars rather than actually doing substantive change. So what we could probably anticipate is that the new Warsh Fed would probably clamp down on DEI initiatives, would probably abandon any kind of green taxonomy or way of thinking, or how that might impact their decision making, without actually changing anything else. That's a possibility. I would say that's probably the most benign possible outcome. There is also the additional point that having rubbished the institution, he's going to have a jolly hard time trying to convince people to go along with it. So he's going to have to mend a lot of burned bridges if he wants people to go along with him. Now, there is also this sort of, kind of alternative out there, a little bit of, a kind of a spike in the tail, because the Fed chair is not necessarily the leader of the Open Market Committee. And usually what happens is the Fed chair is automatically voted as the leader of the Open Market Committee. What happens if the Open Market Committee rebels and says that they're unwilling to make him the head of the Open Market Committee, and they leave Jerome Powell as that position, even though he's no longer the Fed chair? That's a sort of an alternative scenario. Now, if that were to happen, I would anticipate that the dollar would take a dive of epic proportions, and that we would have a really significant crisis here, because it would be the Fed very clearly asserting its independence from the political apparatus. And that would create an even more uncertainty. So it's not like it's a slam dunk. And, he is going to have to make nice with a lot of people in that institution. And quite whether he's going to be able to lower interest rates by political fiat is very unquestionable. I think is very questionable.
Yeah, it almost seems like it's going to be it's a binary thing. It's going to be one or the other. Like if you look at his historical track record, his ideological leanings, you would think this is a tight money guy generally. Obviously, lately he's expressed, he thinks because of the deflation, it's okay to lower rates, which is what Trump wants. And presumably Trump wants somebody who's going to do what Trump wants, which is just lower rates. So we'll see which side of Kevin Warsh comes out. My guess is we're going to see the political animal side. But, it'll be interesting to watch in either case. He's definitely a controversial pick. And people can see into him what they want to see, I suppose you could say.
Yes.
Yep.
Also, I think, the central bank, central banks around the world are very much hostage to the bond markets. And, if we look at countries like the UK or several in Europe, it's when bond yields spike, then governments have to start talking about fiscal responsibility. They have to really start to be responsible in terms of monetary policy. And the 10-year yield did pop through the 4.2% level immediately after Warsh was announced as the potential candidate. So, how the bond market reacts is going to play a very significant role in whether the Fed can cut interest rates. And that's regardless of who's in charge.
That's interesting. Yes. So for those who are new to economics or investing, when the yield goes up, it means people are saying, "Hey, I don't want to buy those bonds so much anymore." That lowers the price. And because the coupon payment is fixed, that mathematically raises the yield. So basically, when Warsh became the presumed next Fed chair, people backed away from the U.S. bond market, which is interesting. One last question, Owen, on this, semi-related. So I think if I recall correctly, I read it quickly, but you wrote to your subscribers that rather than all this balance sheet expansion, which is one of the controversial things now people are talking about with the Fed, having done this a couple of times, we're so used to it now, it's normal. And Kevin Warsh would totally agree with this point. You said you would have liked to see more repo market action. That's a different, if I'm recalling correctly, that's interesting. Can you walk me through that?
Well, the Fed created the standing repo facility about 5 or 6 years ago. And that was a new financial innovation. Now, what it effectively does is it puts the full printing press and power of the Federal Reserve into the short-term money markets. And a
repo is a very short-term loan, basically.
It's an exceptionally short-term loan.
Yeah,
it's basically
like overnight.
saying, I give you money and I promise to buy it back, or I'll take your assets, but I promise to give them back to you, right? As a collateral. So it basically allows the Fed to put an unlimited amount of money into very short-term money markets, and it creates liquidity and infinite liquidity out of nowhere. So we've seen this tool used twice now. And one was during the UK budget problem. So the yields had jumped higher and pensions had really experienced incredible stress. And it looked like the pension sector was going to go bust. So the Bank of England stepped in. They made unlimited liquidity available. They backstopped the pension liability. They did not have to increase the size of their balance sheet. They rescued the sector. And they were able to take that money back out again about 3 weeks later. So it was a very powerful tool used over a very short time period, which fixed the issue and did not massively increase the size of the balance sheet. The big problem with using quantitative easing is that you increase the size of your balance sheet and it never goes back down. So then that liquidity stays in the market indefinitely. We had the same thing by the Federal Reserve when we saw the regional banks are experiencing pressure in 2023. That was after the stock market had been going down, the bond market had been going down in 2022, and then Signature Valley Bank going bust. And then a really significant problem evolving in the regional banks. The Fed deployed the repo facility and said that they would backstop all deposits. Well, that stopped the rot. That stopped the decline. And we saw that regional banks recovered. And that didn't really have an impact on the balance sheet. It went up very marginally for about 2 or 3 months, and then it came straight back down again. They were able to take that money back after deploying it very quickly. And it's really the promise that they will do something and have the capability to do something that then creates that confidence, reinstills confidence in the market without using quantitative easing. And I suspect at least that is what is going to happen in future. We've seen this tool deployed twice now, and it seems to be a preferable tool to quantitative easing. And if that's the case, well, then they can reduce the size of their balance sheets because they have the repo facility, which is limitless cash, completely infinite cash at their disposal.
And I'm not a repo expert, but my guess is compared to QE, where a central bank is buying bonds or assets or whatever, that money is kind of permanently in the system and can be used for longer term purposes. The repo market is generally used to top up something, like if you need to meet a covenant or there's some regulatory requirement, like you're just a little bit short and you need to top it up, which can be important if you have a contractual a crunch coming and you need to meet that. But once you meet that, like, you can kind of breathe, so it doesn't need to hang around for a long time. Is that accurate? How would you modify that?
Well, think about it like that. One of the reasons we had such an enormous problem in 2008 was because some of the banks were allowed to go bust. So it was a real bankruptcy problem, which created a liquidity problem, which then metastasized into an even bigger liquidity problem. And then we saw asset prices declining everywhere all at the same time and massive contagion selling. So if we had then deployed the repo facility and just avoided the bankruptcies and gone into a managed dissolution, for example, of Lehman Brothers, rather than the outright default, that would have allowed a managed dissolution without a massive contraction in the global economy.
Yeah, it was borderline too big to fail, but it failed anyway. There are proponents of that, but I think what you say makes sense. So let me shift, Owen, to the topic of gold, because it connects pretty well to Kevin Warsh here. So here's the stock price, or not the stock. Here's the price of gold, the futures price, not the stock price. It was almost 5,500 an ounce literally last week, and then it plunged down to 4,600. Now it's just shy of 4,900 as we talk. Obviously, gold and silver both declined after Trump announced that Warsh would be his pick, and people thought, oh crap, we got this hawk, let's bail out of gold. Why is it coming back? Moreover, like if I've been looking at gold and I was kind of waking up to it and I think, oh hey, great, it topped and now it went down a bit. Is this a buying opportunity?
I think this is the question that a lot of people are asking, and a lot of people have been conditioned to buy the dip. And from the conversations I've had, I think a lot of people are trying to buy this dip. But I think we also have to just bear in mind that prices went up an awful lot very, very quickly. So the chances are that we're now in a medium-term consolidation, and that we could have quite a lot of volatility. That immediately after a massive decline like this, you often get a rebound. And I think that's what we're getting right now. But often then you get a range and you might even retest the low. And that might happen at some point over the next 2 or 3 months. Now, when we think about who are the buyers, well, the big buyers of gold are central banks. So that wasn't really the retail frenzy, but I think the retail frenzy was certainly in silver. And that's a much more volatile instrument, and it's not really likely to trend in a consistent manner. So I would expect there to be a lot of volatility in silver, maybe less volatility in gold, but I still anticipate that prices will go sideways rather than trend for at least the next several months. But that is very dependent on the direction of the dollar. The dollar has been rallying since Warsh was announced. And I still think that even with the new Fed chair and the potential for more hawkishness, there is no discussion about tackling the deficit. And the volatility we have on the geopolitical front and the weaponization of the dollar, that was the primary reason that central banks were buying gold in the first place, is because they don't trust the USA to hold their assets. They don't trust the bond market. They have to hold something else. But the best time to buy precious metals is following large drawdowns. So we've had a large drawdown. I think it's reasonable to buy some, but not to buy all of your position, because if it is going to range, then you will have additional opportunities to buy at rather extremely low levels. So it's a sort of a wait and see kind of market.
Yep. And that strong dollar that people now expect with a more hawkish Fed governor is also at odds, for what it's worth, with Trump's desires for a weaker dollar to support manufacturing. And by the way, the front page of the Wall Street Journal today had an article and a chart about how U.S. manufacturing is in retreat, despite Trump's Trump's tariffs are not helping; they're actually hurting in that regard. So anyway, just a separate point that our exports are presumably going down if our manufacturing is in retreat. And so, maybe we want a strong dollar anyway, like we're just not an exporter.
I guess there's the other point that a lot of the exports that come out of the USA are either going to be services oriented, like technology, or energy. So we're a bigger exporter of energy now. It's not manufactured goods anymore.
Yeah, or airplanes, right? That sometimes break. Yep. All right. So speaking of technology, our final story today is AI eating software. I'm going to read a short quote from a Bloomberg piece. Basically, Anthropic, and I'll quote in a second, released this tool for in-house lawyers, and that really spooked like the whole industry. It looks like Thomson Reuters was down 16%. This is from the article. CIS Disco, this is in the London exchange, I think, 12%. LegalZoom down 20%. There's a quote from another Bloomberg piece. Technology private equity in its current form is dead. Isaac Kim, a partner at venture capital firm Lightspeed, who previously led Elliott Investment Management's tech private equity business, said in a recent LinkedIn post. So in simple terms, I guess this Anthropic thing spooked the market. They think, hey, do we need external software? SaaS was the hottest thing going a couple of years ago. The SaaS firms traded at huge multiples, but now maybe people can just vibe code in-house and just not need this as much. What do you think, Owen?
I can think there's a couple of different things. One is, why was software as a service so attractive? I think primarily it's because of reliability of cash flow. And I think Microsoft is by far the best example of that. When Microsoft was releasing a new version of the software every couple of years, it was a highly variable stock price. It peaked in 1999. It went sideways for the next 14 years, just up and down. But then they adopted software as a service. They had Microsoft 365, and then it turned a highly cyclical business into a very predictable business. And the share price went up in a straight line, just from bottom left to top right for the next decade. And that's primarily because of the reliability of those cash flows. So if you're a borrower or if you're a lender or you are a private equity firm and you're investing in a software as a service business, and you can buy that at a reasonable multiple, well, then the reliability of the cash flow means that you're going to get your margin, you're going to get your spread over the money that you lent them, and it's going to turn out to be a very profitable way of investing. Well, if now the growth in that revenue base is now questionable, it doesn't even matter if the revenue itself stays static. It's simply that the growth metrics are now being reset. So that basically means that the prices have to come down, because they were commanding very high valuations because of the reliability of the cash flows. But if those cash flows are not reliable and the growth rate is no longer realizable, well, then you have to address the valuation. And that's why these prices are going down right now. But I think that this is going to create a really attractive entry opportunity, because some of these businesses are going to survive this AI onslaught, primarily because they are providing software as well as services to support it. So you have the salespeople, you have the updates, you have the antiviral kind of patches to the software. And we're really talking today about the AI capability, but we don't talk about the sustainability of the AI model as a product that people will actually use on a day-to-day ongoing basis. And we're not quite there with the AI yet. And it can do individual issues. It can answer individual problems. It can increasingly do detailed research. And I think that's really what this whole legal question is about, that it can do research. So it will parse out the different jobs it has to do. It will figure out what it needs to get done, and then it does it. And that is much quicker, orders of magnitude faster than a human doing that kind of work. So that's a really fantastic innovation. But the software, patching, the security, that is still something that you do need companies to get on with. And then there's also software that is going to be provided to a regulated entity. Mm-hmm. And that just cannot have error rates. So there will be companies that survive this. And this drawdown is going to create exceptionally attractive entry opportunities.
So it sounds like you're pretty optimistic. I mean, if I were the lawyer for that side, I would say the thing that spooked the market was this legal, document thing. If I understand correctly, I didn't deep dive on this, but that's a pretty ring-fenced use case. It's pretty limited, and I can see that being more vulnerable to AI than some of these other things, especially with the vertically integrated software. These companies use software in almost every step of their business in some cases, and that's mission critical. And AI is pretty good if it does a document 98% correct, and you just got to eyeball it and fix one or two things, and it does it instantly. That's awesome. But if it does your vertically integrated software 98% correct, that could be horrifically destructive to your business. All it takes is a few small mistakes, and it can create this chain reaction. And to your point, especially if it's some regulated business. So the tolerance of mistakes outside of that ring-fenced use case of legal document creation or whatever they're doing is a lot lower. And so I'm with you. I don't see it quickly replacing. I would see it eroding the businesses, meaning there are probably aspects that the AI can do, and then somebody who's in the know can review it and correct the bugs here and there. So maybe it's not as big of a SaaS industry as we had before, but those companies have huge reach, they have deep relationships, and they're pretty entrenched. And I don't think the average business, at least I wouldn't want to completely punt my software needs to AI, which is still pretty incipient.
I think too that the real innovation is that you're using an agent to manage agents. So that's what the innovation is. That Anthropic is now using this sort of manager app that it can also deploy, that it gives jobs to other AI agents and then takes back the product and collates that information, which is a huge innovation. It basically means you need fewer programmers. So, we're going to have a smaller software as a service sector. There's no question of that. But the survivors will then have a much bigger addressable market. And I think that's where the opportunity lies.
This is totally off topic, Owen, but did you see the news when these AIs got together and talked to each other? They created their own religion, this Church of Molt. I don't know how they came up with this, but it just, in terms of AIs, managing AIs, like this is probably the future. And they didn't let any people into this. This was just all created by AIs. It's pretty interesting and scary at the same time. We're going to see a lot more of that, AIs on top of AIs, and where does it go? I'm still kind of, AI to me works like a big autofill, like you're typing a Word document, right? And so it's for the writing, it's like if you don't need high-end writing, like you're making a glossary or an instruction manual or something, or just even like a news story outline, like, okay, or here's a summary of today's news or this week's news. AI is good, but it doesn't do high-end writing yet. So I'm too snobbish to use it really in that regard. But I don't know. I think and so when you have a bunch of those autofills talking to each other, right? It looks impressive, but the actual, it's just rearranging concepts. The actual originality is not there. It's just a rearranging tool. Perhaps that will change. Obviously, it will change if we can get the general intelligence.
I think what AI is, just from our sort of standpoint, is that it's a line of best fit. And if you really think about the job of an analyst, it's to collate the information and make the logical leaps, and to perform second and third order thinking on top of it. And I don't think that AI is there yet. It's the second order and third order thinking is where the value is in any kind of analysis. simply reporting or regurgitating facts. That's largely the work of journalism. It's not analysis.
Correct. And this would put a greater premium, it would seem, on the second and third order thinking, because the first order has become increasingly commoditized. So if someone is strategic, use that skill, because it's probably going to get even more valuable, because and that's probably all you got left, because AI is doing the easy stuff.
Sure.
So
but I think that's also what the market is doing, is pricing that in.
Yeah, exactly right. And I think we're seeing a little bit of a retrenchment now. We are seeing it, and skepticism now around OpenAI, which was like the darling 6 to 8 months ago. Now, at least a friend of mine is comparing it to WeWork. Is it this? They just got too big for their britches, and everybody's fawning all over them, and it went to their head. I don't know the answer, but I think this is how society figures out these sorts of things. So let's shift to the tangible takeaways now, some stock ideas, and we will bring back analyst Xiaoping Huang. Welcome back, Xiaoping. So we're going to share a few ideas that we are each looking at. Xiaoping, why don't I throw you in first? What is your idea this week?
So today I'm gonna talk about Constellation Energy, ticker CEG. So like people like right now are all like chasing AI boom, mainly talk about like big names like Nvidia, Tesla, but the valuation is actually sky high. So they might not be comfortable with it, but Constellation is more like the one who's powering the AI boom behind the scenes. It is the largest carbon-free power producer in America. It has 21 nuclear reactors. So it had an incredible run in 2025, but the valuation then is really high, but pulled back over 30% since last October, which is the reason I think it is a bit more attractive right now. So earning
Yeah,
growth
down
is good.
30% year to date as well, down 8%
Yeah.
today even. Yeah, wow, interesting.
Mm-hmm.
Here's a 1 year chart
So
I'm looking
earning,
at.
yeah, it's fundamental is still good. Earning growth and cash flow like is excellent, and they also have contracts with Meta and Microsoft of over 2,000 megawatts for the next 20 years. And the current PEG ratio is about 1.3, meaning
Okay.
for every 1% of growth, like you're paying 1.3 times in valuation, which is not really overvalued for a utility with AI exposure. But the price drop is mainly because of the government intervention. The government basically said we're not going to let power companies charge whatever they want just because AI needs electricity. So that kind of threatened the whole profit story. But like if you believe in AI power, demand is real and the market is a bit overreacted, this pullback is probably a good potential entry point.
Interesting. Yeah, it's really gotten whack. And I think the rub is, obviously we got all these data centers popping up and they need power. Who exactly pays? How much does the average ratepayer pay? Like how, because they need beefed up transmission lines, substations, things like that. There's more infrastructure. And, traditionally, if a new factory comes to town, it kind of gets baked into the overall rate base to an extent. But these AI data centers are so big and suck up so much power. People say it wouldn't be fair to have just, Joe Q average subsidize that. And I think the government is agreeing with that. And so in other words, that potentially dings Constellation a little bit because it makes what they offer a bit less attractive. But I don't know. I think demand elasticity might be high enough that their business keeps up. So interesting stock, definitely less volatile. They've already had their whack and less vulnerable than like, I don't know, Nvidia or one of the poster child AI plays. So cool. Owen, what are you looking at today?
The thing that I am kind of concerned about right now is that there is a bit of a migration of capital outside the USA.
Mm-hmm.
And a lot of that is betting that the dollar is not going to sustain its rally and that we're still in a bear market. And I think it's very interesting that now its defensive plays are starting to perform in the market right now. That there is a sort of a migration out of AI and out of technology and more into the kinds of things you can touch. I think it's interesting that Procter & Gamble has broken its downtrend. I like the fact that this is a highly diverse company, but very much focused on the consumer, and not just US consumers. It's a truly global company. So it's also a dividend aristocrat, which means that it has been raising its dividend every quarter for decades. And the Dividend Aristocrat ETF has now broken out to a new all-time high following a range of the last several years. That's despite the fact that interest rates have not really started to, or the yields have not come down much. I think that we're starting to see more demand for defensive companies, and that's usually in tandem with a sell-off in the wider market. So I think it's a good place to hide out.
Beta of 0.38 or not 0.38, depending on which part of the world I live in. Yeah, very interesting. It's been kind of dead money since the beginning of 2022, according to this chart. I'm looking at Yahoo Finance, but to your point, look at the recent trend. As of whenever, kind of, middle to the end of January, it was kind of at its low point, and it's really rocketed up. This past month has been fantastic for P&G shareholders. So yeah, it's definitely broken a trend. It has boring but essential stuff that people need. I think these kinds of companies were kind of unloved for a while because consumers were buying a lot of the store brand stuff, which ironically in some cases is made by these big brands, Unilever and P&G. But maybe they're seeing their day. So P&G, interesting. As a former dividend stock newsletter writer, P&G was certainly close to my heart as well. So I will jump in with another Constellation. But this one, Constellation Software, this is a Canadian company run by this, created by this sort of bearded recluse, Mark Leonard, who is retired now due to health reasons. This is one of these beaten down companies, software companies, but they buy these vertically integrated software providers that are typically in niches that are hard to replace. And arguably, this is the least vulnerable segment of software to AI, just because of regulatory reasons and how integrated it is into the business. This guy has been a phenomenal acquirer. In general, this has been a pretty good performing stock until recently. If you look at this stock from, I don't know what the starting year is, 2007, until they peaked around roughly last summer, early fall, early autumn, August. The threat is AI, and everybody is scared about that. And maybe they're right, but if someone is bullish, maybe thinking like you, Owen, that this AI related sell-off in SaaS is overdone, Constellation Software, it's known for a very responsible corporate governance, being a very good capital allocator, very disciplined type of business, high quality company whose cash profits exceed its accrual profits, meaning it's not using accounting tricks to juice its performance. In fact, almost the opposite. They're a bit conservative with their numbers. So Constellation Software could be another constellation if you're in the mood to pounce on this downtrend caused by AI fears. So those are the three stocks for the day. Hope they've been interesting to you guys watching. As always, we love any feedback, thoughts, questions, remarks. Happy to discuss anything that's on your mind. And thanks for watching us. Owen Tracy of Fuller Tracy Money, thanks as always for your perspective. You always amaze me how deep you can go on just about everything. And I've gotten to really enjoy your missives through your newsletter. Xiaoping Huang, thanks for your stock, Constellation Energy. I think that's a very good play. So, all right, guys, that's it for this show. Thank you so much. And thanks to you guys, as always, for watching us at home.